Hello traders, 2025 is around the corner and it might be another volatile year for FX markets. Donald Trump is taking the White House in January and he has a rich political agenda to deliver, including aggressive import tariffs, generous tax cuts, and migration controls, but the timing and the size of those policies is quite uncertain. The impact of those policies is also far from known, so that could be a key source of volatility. And don't forget that he also pledged to end the war, so it will be interesting to see how and if he will manage to end the geopolitical risks. And of course, the Bank of Japan might be also a hot topic. The central bank, unlike other global central banks, is thinking to raise interest rates. So let's now have a look at the technical signals, and particularly let's see what the weekly chart suggests for those pairs. And starting first with dollar yen. Dollar yen is set to finish the year with a gain of 8.11%. That's because of the Fed's switch to a more gradual rate cut approach, as well as the fact that there was some uncertainty about whether the Bank of Japan will continue with the rate hikes. So that helped the pair to remain within the 150 area. And of course, the resilience in the US economy was another support for this pair. So we can see that the price is currently trying to rebound near the 20 and 50 exponential moving averages near 149.75. That's an encouraging sign for the market, especially as the RSI and the MACD remain within the positive area, and the stochastics are approaching the oversold region, suggesting that selling pressures may ease. So if that rise continues, I would like to see a close above 156.60 to become more confident that the rebound will continue. This is the lower band of this steep broken bullish channel. It's where the price posted a new lower high. So if we successfully surpass it, that could boost buying appetite, bringing the 160.70, 162 region back into view. We saw the price peaking around this multi-year high back in June, so a successful move above this zone could bring some extra gains, probably the 164.60 level back into in focus. That's where this resistance line coming from October 2022 is located. So there might be a tough battle here. If the bulls win this battle, then all the attention will turn to the upper band of this steep bullish channel seen at 168.35. Of course, those levels are quite extreme, given the fact that the Bank of Japan may not be very happy to see the Japanese yen weakening to such levels. So that could signal some intervention from the central bank. However, that wouldn't be impossible if there is significant weakness in the global economy, in which case a weaker currency could benefit exports. So now if we look to the downside, a break below 149.75 could trigger new selling pressures, likely bringing the 142 region into view. That's where this support line from 2023 is placed. While slightly lower than that, the 139 mark would be also protective. This is where this line connecting the lows from 2023 and 2024 is placed. So as long as we hold above this line, then that wouldn't be very concerning. If we break below that and also fall below the 200 exponential moving average at 137, then that could signal a bearish trend reversal, and specifically that would also chart a bearish head and shoulders pattern over here, signaling a bearish continuation. So in this case, support could come around 131.92. That's where the 50% Fibonacci mark of this uptrend coming from 2022 lows is placed. Now looking at euro dollar, the pair is set to finish the year negative with a loss of 4.70%. It hit a 2-year low of 1.0330 back in November, but encouragingly it returned within this rectangle, so that gives us some optimism that A recovery might be likely in the short term, particularly as the RSI and the stochastic oscillators have already hit oversold levels. Nevertheless, there are a couple of negative facts in the euro area, including noisy political troubles in France and also in Germany. The stagnation of the euro area is not positive for the euro, and of course the wars in the neighborhood could also weigh on the euro currency. So a sustainable bullish reversal seems to be the least case for this pair at the moment. Perhaps a break above 1.0610 could help the price to rise within the 1.08, the 1.0850 territory, and then perhaps test the 200 exponential moving average at 1.0930. If we continue higher, then a tough battle could emerge near 1.12 and 1.1250. The pair must surpass this territory to signal a bullish trend reversal, and we can see that the price posted a bearish double top within this region, so that's a red warning for the market. However, if we successfully surpass and create new higher highs, then that could boost buying appetite towards 1.1485 or 1.16. But again, if we look at the moving averages, we can see that the 20 weekly exponential moving average has failed to cross above the 200 EMA and then pull below the 50 EMA. So that gives us another negative warning for this market. So sellers may wait for a break below 1.0470 before targeting again the 2-year low 1.0330. Below that, the 1.02 number, which coincides with the 61.8% Fibonacci mark, could be also a key pivot point. If it fails to hold, then all the attention will turn to parity, and perhaps there might be some consolidation between 1.0075 and 0.99. If we see further weakness, then I expect support to come between 0.9670 and 0.95. We have a couple of support trend lines, long-term trend lines to watch within this region, and particularly those lines are coming from 2000. And finally, looking at pound dollar managed to hold within a bullish structure within this above the support trend line. It's currently set to finish the year with a marginal gain of 0.36%, and that's because of a political shift to the left back in July, as well as the gradual rate cut policy by the Bank of England, which helped the price to which prevented sharp declines in this market. So if you look at the technical indicators, those are rising at the moment, but they are not within the bullish area yet. So the pair is not out of the woods. Perhaps a break above 1.28, where the 250 simple moving averages are converging, may help the price to run up to 1.3045 or 1.32. The higher than that, the price may attempt to post a new higher high somewhere between 1.34 and 1.3525. This is where this resistance line coming from July 2023 is placed. And it will be interesting to see whether the 50 and 200 weekly moving averages will manage to post a bullish cross. If not, then that would be a negative trend signal for the market. However, selling pressures could strengthen only below 1.2530 and below this support line, in which case the price could visit the 50% Fibonacci mark of this down leg at 1.2285, a break of which could then see continuation towards the 1.2020 region, where the price pivoted back in October 2023. And of course, additional declines from there may cause another downfall that could be below 1.20, likely breaking the 1.1820 mark into view. That's where the 30.2% Fibonacci mark. So that's my outlook for dollar yen, euro dollar, and pound dollar. Thank you for watching. More outlook videos will follow in the coming weeks. If you like my video, please subscribe and like the video. And of course, we'll be back soon. Thank you for watching and see you next time.